what we should now do is take a look at the dividend discount models and say, okay, what is the whole point of a dividend discount model? Well, why would we ever use a dividend discount model? Everybody's not going to use a dividend discount model to value a firm's shares because number one, what happens when a company doesn't pay a dividend? Can't use a dividend discount model. Number two, when would you want to use a dividend discount model? You want to use a dividend discount model if you're trying to value the firm's shares from a minority shareholder's perspective. In other words, if you own 50% of a company or more, you technically have control of that company. So you wouldn't look at it from a passive standpoint or minority shareholder's perspective because you're really a majority owner. You own more than 50%. So generally we use dividend discount models if, number one, we're trying to value the firm's shares from a minority shareholder's perspective. Number two is that the firm actually pays a dividend. And number three, we would use a dividend discount model if we believe that there's some kind of stable relationship between dividends and earnings. In other words, as earnings grow, the amount of dividends that are paid out grow. If earnings go down, then the amount of dividends that are paid go down. So there's some kind of stable relationship between earnings and dividends. Under those three circumstances, we would want to use a dividend discount model. Because remember, as I said before, there are different ways to value a firm's shares. We can use dividend discount models, we can use residual income models, we can use the multipliers approach, we can use asset-based models, we can use free cash flow models, many different ways that we could try to come up with the value of a firm's shares. So the dividend discount model is going to be the first one that we look at. And why are we using the dividend discount model? Because we're saying, you know what? How do we come up with the value of a firm's shares today? Well, one of the basic tenets of finance is that the value of an asset today is the present value of its future cash flows. The question is, what are we going to use as the anticipated future cash flows? If we're a minority shareholder and we don't have influence over that company's operating, investing, and financing decisions, and all we do is get a dividend, then we would say, you know what? The value of those firms' shares to me is the present value of its future cash flows, where the cash flows are identified as the dividends that we receive. So if you actually take a look at the screen that you have in front of you right now, you will see that in the top I show you that if I wanted to come up with the approximate price of the stock today, that's the little hat over P sub 0, because that's not the actual stock price. The actual stock price is whatever that stock price is in the marketplace. The price of the stock today, the approximate price of the stock today is equal to what? A future stream of dividends, D1, D2, D3, D4, D5, D6, all the way forever D infinity. And then we're going to discount each of those dividends by a particular discount rate, whatever we determine it to be. And we could use a different discount rate for each cash flow, or we could use just a single discount rate. It's all up to us, up to the analyst. So what we're doing in that formula is saying that the approximate price of the stock today should be the present value of the of the dividends of an infinite stream of dividends. Now, why did I put an X through that formula? The reason why I put an X through that formula is, well, if a company is an ongoing concern, and we're going to assume that as an ongoing concern it could pay a dividend forever, how do you want to value an infinite stream of dividends? Meaning, dear Google, you can't. So we need to make some simplifying assumptions. So what we do is we make some simplifying assumptions, such as we're going to, number one, assume that the required rate of return is constant. Number two, we're going to assume that the company pays a dividend, but the dividend is only paid out once a year. It's not paid out like in the real world quarterly. In the United States, companies pay dividends out quarterly. So we're just going to assume for simplification purposes that all of the cash flows, the dividends occur once a year at the end of the year, like on December 31st. So that will be consistent with the end mode of our financial calculators, where we assume the cash flows occur at the end of the year on December 31st. And we're also going to assume that that the company is growing at a stable rate, meaning that the company is a mature company, it's at the mature stage of the industry life cycle, and therefore it's growing at more or less the rate of the economy or 1 or 2 percentage points more than the economy. If we assume all of these factors, constant required rate of return, the dividends The dividends are paid out annually instead of quarterly. And we also assume that the investor's required rate of return is greater than the growth rate and that the company's growing at a stable rate. This entire formula will collapse. And that's why we cross it out. And it will become the formula that you see directly below it, which is that the approximate price of the stock today is equal to the next expected dividend, D1. Notice it's not D0, D1, over R minus G, where that's the required rate of return minus the growth rate. That formula is a must-know formula. That is called the constant growth dividend discount model. It is a discounted cash flow model. It's also known as the Gordon growth model. On the exam, sometimes they will refer to it as the Gordon growth model. You need to know the formula. This formula is a must-know formula, and we're going to talk about each of the components of this formula and how we derive it, and then we're going to do a problem just based on this formula to show you how they've tested this before on the exam.